Thursday, the 10th of October. We have critical price points as usual. This is the weekly chart, daily chart, weekly volume imbalance. We measured this wick. 75% of the range of that is in close correlation to the daily volume imbalance high. And if we measured this wick, then we see that 25% range is just above the daily volume imbalance high. So we have a point of resistance in here. How do we determine that? How do we determine that point of resistance will become clear later on. We have a 1 hour fair value gap in here. We don't close that all the way down. We could have thrown to that, but if we close in here, we could have inversed that and then seek lower prices, but the CPI data left relative equal highs, so there was a reason for us not to trade below that, but to just go up to that bullish, have some bullish momentum to take out these highs with the purpose of leaving a portion open and not trade down to the volume imbalance high even, which is what we did here. We see the 50-minute fair value gap. We wick that, we mohawk that, and it's important. This price is important, the daily 25% of the daily wick, because we have sell side liquidity resting below here. Eventually we rate that, then we trade higher to the minor buy side smooth highs after CPI, and even higher to primary buy side liquidity. We have 177 possible to get from this entry point to here. That's $300, $400 something, with one contract in the micro, 4,000 with one contract in the mini, and 40k with you do the math. So then we have the price delivery algorithm. We have primary buy side, major buy side on the Nasdaq and on the S&P. We have minor buy side taken, so on the CPI data, so we have an SMT, and now we don't go up to primary buy side. In the NQ we do, and it looks a little bit different from each other. We have one fair value gap resting here, and the Nasdaq, the S&P, we have one fair value gap resting here. Now with the Dow Jones, these inefficiencies look the same. This high is also being taken, so we failed to swing this high, which is momentum for down and then up. So now the price delivery algorithm is that we drop down in here initially, we go back and forth, we leave relative equal lows, relative equal highs, we drop down, we take all these sell sides, re-rate this sell side liquidity, then this fair value gap catches my eye, with this fair value gap also, so this high, so this low, if we draw that out in time, we'll see that it comes down to here. This is the fair value gap that took out this sell side, so we want to see that inverse, we do that, but this is an important fair value gap because we have all that back and forth coming back into it. So we reverse that, we touch the high of that, and then while we reverse that, we do that in a momentum, we leave inefficiency, we trade back into that, also back into that inverse fair value gap in here. Let me check on the chart again. Yep, so that was actually the fair value gap that should also have been annotated, this one. So we are inside the macro, we drop down in here on the 15-second chart, it would look amazing, but for now the order block is sufficient for me, with the expectation of inversing this fair value gap in here. So we come into that, we trade higher, and then we trade back and forth in this first percent of fair value gap. Once you trade down into that, this fair value gap, that's high conviction, this low, this fair value gap is high conviction, so we trade higher, we have relative equal highs, we trade below that to take out sell side, we trade up, don't make an attempt to take out buy side, we leave relative equal lows, we trade out sell side again, then we finally take out all the buy side in here, and once we come inside this second macro, we are leaving this wick alone, and then we sweep all these lows in here that were resting in here. We don't close In here we want to see this inverse because we have a sweep of this, so we want to see this inverse much like this. We don't get that, then we sweep this, and then we want to see this inverse initially. Here, but we get that sooner, so that's good. But that could have also been the entry mechanism when price came down till the high of that fair value gap. Then yes, we enter, but for now, oh, for now, let me erase this stuff. For now, this is sufficient. We trade higher. We have the 50-minute order block in here. We see the bodies respecting the midpoint of that first value gap. We leave with momentum, and once we trade down in this inefficiency, we want to buy a long position. Then we have a 5-minute fair value gap. We draw into that in this 1 minute inefficiency in here. We turtle soup that here. These lows, we turtle soup that. Then the low of that, we trade for a higher position. Or we can treat that for narrative to trail down the stop loss, because in here, if I was here and price would come in here, once we inverse this, then my stop loss would go to my from here to my entry, and after second stage accumulation, this point in here, then my stop loss would come in here. ICT, when he saw this, he stopped the trade. Yeah, pretty insane. And then everybody went short, and then everybody wicked, and then we went higher. So, all right.